This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Full speed ahead. For now, stocks rally for a second day in a row as investors and the world await tomorrow's big decision from the Federal Reserve.
Blue chip warning. Shares of 3M tumble after the manufacturing behemoth lowers its earnings forecast, blaming the slowing global economy.
A dangerous epidemic, the new problem that's plaguing the American workplace. All that and more tonight on Nightly Business Report for Tuesday, December 15th.
Good evening, everyone. I'm Sharon Epperson, in tonight for Sue Herrera.
And welcome, I'm Tyler Matheson. Stocks rally one day before the Federal Reserve is likely to make an historic decision and exit its era of 0% interest rates. The two-day Federal Reserve meeting began today, a day that saw broad-based stock market gains and a rise in oil prices. That, as you might expect, helped lift the energy sector. By the close, the Dow Jones Industrials were up 156 points to 17,524. The Nasdaq added 43, and the S&P 500 was up 21. Bob Pisani has more on today's gains ahead of tomorrow's big meeting.
Stocks had a positive day, though they came off their highs towards the close. Now, a big help was that the two biggest problem sectors, oil and high-yield bonds, both behaved themselves today. It also helps that we're entering a seasonally strong period of the year and that this is the time of the month when tax selling your losers for the year for tax purposes, generally abates. There's a problem, though. It's the Fed. Most traders accept that the Fed really wants to start raising rates. That's not so much a problem. The issue is how fast will they raise those rates? Most expect the Fed to be very dovish. That is, they will say they're going to raise rates very, very slowly. Now, the concern is that the Fed's chair, Janet Yellen, may, inadvertently or not, adopt a more hawkish tone. That is, she may imply that they'll raise rates more in 2016 than traders are expecting. That could trigger a wave of concern, which means traders might sell stocks quickly. You can see a lot is riding on what the Fed is going to do and on their tone. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Our guest tonight says the equity market is set up for what he says will be a rip-your-face-off rally that will surprise a lot of people. He's Jeff Sott, Chief Investment Strategist at Raymond James. And Jeff, you are saying, and your models are saying, what a lot of market watchers aren't saying. Why do you think we're going to see this rally, and over what period of time?
Well, first of all, I think the markets were massively oversold. They were as far below their 50-day moving averages. They've been as oversold as they've been in the past 3 years. And secondly, you're into this option expiration that everybody's worried about, this $1.2 trillion option expiration. And historically, December option expirations have been positive for stocks. The VIX, or volatility index, is in backwardization, meaning you're paying more for near-term protection than you are for longer-term downside protection. And the last reason is you've entered the Santa Claus rally period. And I've learned hard over the past 45 years, it's tough to put stocks down in the ebullient month of December.
Your model pretty much called the August bottom, also a turn there in October, as I'm recalling here. So history is on your side, but an awful lot of the other commentators aren't. They see much more modest returns heading into the end of the year and into 2016. How do you counter them?
Well, there's a high short position in the equity markets. Everybody's bearish. I mean, there's a ton of money on the sidelines. Money managers are underperforming. If there is a big rally here, they're going to have to buy and participate because they have at year end not only performance risk, they have bonus risk, and ultimately they have job risk. So if the market vaults here to the upside, which is what I think is going to happen, you're going to have a lot of people climb on board, at least on the professional side of the equation.
So you've been talking about money managers, but what about individual investors? What should they be doing right now with their money?
They should be looking, in my view, at midstream master limited partnerships, not the upstreams that have price sensitivity to crude oil and nat gas, but the midstreams that are basically toll takers with the pipes and the storage. They have decent yields. You're getting the first time in years to buy some of the big cap quality midstream players. And I think if you bought those and went into a coma for 2 years, I think you make a lot of money.
All right. Good advice there from Jeff Sott with Raymond James. Thank you.
Well, market experts expect the central bank to hike interest rates as many as 3 more times next year. This according to the latest CNBC Fed survey of leading economists and market strategists. As a result, most respondents believe that's bad for stocks, for housing, for the economy, and they have raised the probability, really just the possibility, of a recession in 2016.
Now, when the Federal Reserve makes history by hiking interest rates for the first time in nearly a decade, that's what everyone's expecting. What might happen to stocks, not just tomorrow, but in the weeks and months ahead? Dominic Chu takes a look at what investors can expect.
There are some important reasons why the Fed is looking to change its ultra-low interest rate policy, a policy that's been in place since the end of 2008, near the depths of the financial crisis.
Our growth in the U.S. economy has been running pretty consistently over the last 6 years at about 2 to 2.5%. Yes, that's below average, but it's pretty good. You add in a little bit of inflation, which we have had a little bit, and that tells you that long-term interest rates should theoretically be about 3%, and we've been at 0.
While it's not a sure thing the Fed will do so, investors are preparing for what to do assuming that a rate hike happens. Some are looking towards history for clues as to how the market will perform in the wake of a Fed interest rate hike. There have been 4 times since 1990 when the Fed has raised rates after a period of lowering them. And according to market data and analytics firm Kensho, in each of those 4 times, the overall stock market averaged a negative return 1 trading month after that rate hike took place. The large-cap S&P 500 was lower by an average of around 2.5% and posted a negative return each of those 4 times. But that doesn't have all the experts worried. Some are looking beyond the rate hike and what could be shorter-term volatility, and they could see longer gains ahead.
What's happened this year is the market's gotten very narrow. We've had decent earnings growth outside of certain sectors, and that's what's masked the global, the averages in the U.S. So a lot of strong U.S. companies across many sectors are trading at low double-digit PEs. So we think there could be a pretty healthy multiple expansion along with some healthy earnings growth in the U.S. next year.
If the Fed does end up raising interest rates, some sectors could be bigger beneficiaries than others.
We think that if we're making any changes in 2016, it's probably going to become more defensive, add bonds back to the portfolio, potentially add some bond proxies towards the end of 2016, like utilities, like real estate investment trusts, like consumer staples. We think that there are fundamental changes going on in the consumer backdrop that may really require us to rethink consumer discretionary in 2016.
One of the big concerns is that we have never had a rate hike after a prolonged period of ultra-low interest rates. So history may be a guide, but many investors are still moving ahead with an abundance of caution. For Nightly Business Report, I'm Dominic Chu.
The Federal Reserve's decision on rates won't just be felt here, but also outside the U.S., and no place is that more true than in the emerging markets. Seema Modi explains.
The effect of an interest rate rise by the Federal Reserve and a strengthening dollar could spell trouble for the emerging world. Economies that are most vulnerable, according to TD Securities, Brazil and Turkey, given that they borrow heavily internationally to finance their economies. Rising interest rates means the cost to finance these loans will also rise as their currencies depreciate relative to the U.S. dollar. Countries such as India, with huge corporate debt exposure to the U.S. dollar, will also be adversely affected by a stronger greenback, as many companies there have taken loans in dollars. A rate hike would make that debt financing more expensive, which analysts say could spur a credit crisis. The third group includes countries that have fixed their exchange rates to the dollar, China being the key example. If Fed Chair Janet Yellen indicates rates are on the rise, the dollar could surge, which would mean the Chinese central bank, which is already spending a lot of money trying to stimulate its economy, would have to invest more to maintain its exchange rate. Hence why last week the central bank indicated its intention to depeg the yuan from the dollar and measure its currency against a basket. Bottom line, the negative implications of a rate hike on emerging market economies have not gone away. For Nightly Business Report, I'm Seema Modi.
The Federal Reserve has been a popular issue on the campaign trail. Rand Paul has repeatedly said he wants to audit the central bank, while Donald Trump has accused Fed Chief Janet Yellen of keeping rates low to help President Obama. Given all the criticism, it's getting harder for the Fed to keep its non-political reputation intact. Eamon Javers is in Washington with more on the politicization of the Fed. And Eamon, leaving Hillary Clinton aside for a moment, If any of the other candidates are elected next fall, how would the relationship between the White House and the Fed change in 2017?
Well, I think it's got to be different next year if one of these Republicans is elected president in 2016. If you look at it, in the past, we've seen presidents have tensions and problems with Fed chiefs. There's no doubt about that. But what strikes me as new this year is the degree to which we see these candidates out on the campaign trail campaigning against the Fed overtly. And that is a rallying cry for a lot of voters in this country post-2008 who look at the Fed as this sort of mysterious and complicated thing in Washington that's not really democratic. It's maybe controlled by the bankers. It's kind of confusing, and it has a lot of power. All of that makes it sort of an easy poster boy for everything that's wrong with the relationship between Washington and Wall Street for a lot of voters.
What sorts of structural changes would some of these candidates like to see visited upon the Fed?
Well, one is that you've seen Marco Rubio out there calling for an end to the Fed's dual mandate. Remember, the Fed has to keep two things in mind as it does its job. It's worried about inflation, but it's also worried about job creation. Marco Rubio has suggested that, maybe it should really just be worried about inflation and kind of stick to that knitting. That would be a sea change for the Fed. It's a question of whether or not he could get that done if he were elected president. But you've seen other comments from some of the others as well. Donald Trump has said that he's benefited over his career from the Fed. He's certainly benefited from low interest rates as a developer, but he says he suspects that Janet Yellen is a political person and that if they begin raising rates, something bad might happen to the U.S. economy.
All right, Eamon, thank you so much.
You bet.
And today we got some new data on the economy, including inflation numbers, which Eamon just talked about. It's important, of course, to the Fed, part of that dual mandate, as he just mentioned. Consumer prices unchanged in November as declines in energy and food held down overall costs. The central bank would like to see inflation around 2%.
Still ahead, an epidemic that is ravaging communities is now being felt in the American workplace.
In Washington, lawmakers continue to work on a $1.1 trillion bill that would keep the government funded. But there's one issue that's holding things up, and that is energy policy. Republicans advocate an end to the oil export ban. Democrats say that if the ban is lifted, it has to be paired with clean energy initiatives.
A warning from a Dow component. 3M is cutting its forecast for earnings and sales growth, citing slowing demand across the globe. That pressured shares of 3M falling 6%, making it the worst performing stock on the blue chip index today. Deirdre Boza has more on 3M's sudden warning.
When 3M worries about global growth, the broader market worries too. So when the manufacturing giant blamed a sluggish global economy for its second guidance cut in as many months, the sell-off was swift.
It is a surprise. A lot of investors gravitate to 3M thinking that this is a safety stock. And we've always said that 3M has vulnerability at negative inflection points in the economy, just like what we're seeing here.
3M is considered a barometer of global economic health thanks to its huge overseas footprint and diverse business lines, which make everything from Scotch tape to Post-its to sandpaper. The company is now expecting full-year growth of about 1%. That's down from its previous guidance of 1.5% to 2%. A few months ago, it trimmed 1,500 jobs in a global restructuring effort. 3M, though, isn't sounding all the alarm bells. It expects slow growth to continue in the new year, but not a deep global slump.
We're not seeing anything that would suggest that the economy is, and for 3M's businesses, are deteriorating to the speed at which you would say it's a recession. It still feels like it's going to be a low growth, no growth type of environment.
The strengthening dollar, however, is another issue that may worsen, and not just for 3M. If the Fed raises rates tomorrow, the greenback is expected to continue to climb, making products more expensive for consumers in other currencies and hurting international demand for 3M and other large U.S. companies with overseas sales.
FX pressure has been part of the relentless pressure on all these global companies. So for 3M, 65% of their earnings are outside the U.S. FX pressures was a big impact on 2015, and we think this carries into 2016.
As several other U.S. industrial companies get set to give their outlooks this week, the market will be listening carefully to see if they follow 3M with more guidance cuts. For Nightly Business Report, I'm Deirdre Boza.
Another big stock mover today was Valeant. The embattled drug maker struck a long-term 20-year drug distribution deal with Walgreens. That sent shares of Valeant up 16%, while Walgreens Boots Alliance fell just fractionally. Meg Terrell has more on the deal and Valeant's reasons for doing it.
In the agreement announced today, Valeant will offer a 10% discount to Walgreens on its dermatology and eye drugs. It'll also offer more than 30 branded medicines at generics-like prices, at discounts of 5 to 95%. Valeant CEO Mike Pearson today saying that while he estimates these discounts will save the healthcare system up to $600 million a year, it will drive growth at Valeant.
What we're doing is bypassing the traditional pharmaceutical distribution system, which allows us to save substantial amount of money in terms of system costs. So rather than selling to middlemen, what we'll do is directly deliver to Walgreens.
The deal comes 6 weeks after Valeant cut ties with the controversial Philidor Specialty Pharmacy after serious allegations about its business practices. Valeant stock had lost almost 60% in the 3 months leading up to today, after a short seller alleged it was using the specialty pharmacy to commit accounting fraud. And the company faces several federal investigations into its drug pricing practices. Valeant says it believes its accounting for Philidor was appropriate, but it cut ties quickly because of investor reaction.
There's been no proof that these allegations are true. I was unaware of any of the allegations going on.
Analysts say the deal with Walgreens is an unexpected vote of confidence, and its 20-year length may signal Valeant's need for credibility. The agreement spans Walgreens' more than 8,000 U.S. retail pharmacies. We'll hear more tomorrow as Valeant hosts an investor day in Newark. For Nightly Business Report, I'm Meg Terrell.
A short seller flips his position on lumber liquidators, and that's where we begin tonight's Market Focus. Hedge fund manager Whitney Tilson has said that the flooring retailer would see its stock price go to zero. But now he's changed his mind, saying he received information indicating the company's management wasn't aware of potentially dangerous chemicals in its flooring. The shares were nearly 25% higher to $17.53. Shares of Advanced Auto Parts spiking on an unconfirmed report from Street Insider. According to the outlet, the company is exploring a sale following an approach from a possible buyer. Shares were almost 6% higher to $156.30. And Qualcomm has decided not to split itself up. The chip maker has been under pressure from an activist investor and has said that it reviewed the option of separating its chip and licensing business, but concluded that the breakup wouldn't be beneficial. Shares were up 2.5% to $48.02.
Concerns about iPhone sales continue to pressure shares of Apple. Yesterday, Morgan Stanley cut its iPhone sales estimate, and today, a key Apple supplier pre-announced a negative sales warning. Shares of Apple down nearly 2% to 110.49. Smith & Wesson saw its shares slide following a New York Times report. A New York City public advocate is asking regulators to investigate whether the firm had made adequate disclosures in its financial statements. This according to the newspaper. Shares of Smith & Wesson tumbled almost 10% to 21.42. And Baker Hughes and Halliburton have announced that they had extended the time period for closing a proposed merger. The firm said the Justice Department wouldn't make a decision today on whether to greenlight the deal. That was the deadline, so they'll push the deadline back to April. Baker Hughes fell a fraction to 46.50. Halliburton was 1.5% higher at 37.10.
There is a new problem gripping America's workplace: prescription painkillers. Employee abuse of these drugs is a growing problem nationally. And as Dina Gazowski explains, if the problem isn't dealt with, it could become very, very costly.
Maine has been particularly hard hit by this epidemic.
Opioid use is a serious problem in my home state of Washington as well. Tennessee ranks near the top of the list for prescription drug abuse.
It's a problem that's plaguing this country. And now a new report says prescription painkiller abuse is affecting the workplace in particular. According to a survey released by the National Safety Council and Indiana's Attorney General, 80% of Indiana employers have been impacted by prescription drug misuse and abuse. But it's not just Indiana.
This is a national problem, and it's really important for employers to understand that this is an issue they need to pay attention to and not put their head in the sand.
President and CEO of the National Safety Council, Deborah Hersman, says not dealing with this problem will cost businesses big bucks.
Injured workers receiving multiple opioid painkiller prescriptions have 4.7 times as many days off.
If an employee is taking a prescription painkiller, their costs on workers' comp go up by 4 times, and 25% of all of prescription costs in workers' comp are opioid painkillers. Employers need to know what medications their employees are taking, particularly if they're in safety-sensitive jobs. We wouldn't want our child's school bus driver, the pilot of our airplane, or the truck driver on the road beside us taking drugs that were impairing.
The most recent figures suggest that prescription opioid abuse cost the United States upwards of $60 billion, with almost half of that attributable to workplace costs like loss of productivity. Lawmakers and officials say that a comprehensive approach, which includes treatment, should be considered for this epidemic that results in about 44 deaths per day. While only about half of employers have a written policy on using prescription drugs at work, according to the survey, nearly 2/3 think prescription pills like Vicodin and Percocet are more problematic than illegal drugs. For Nightly Business Report, I'm Dina Gosofsky.
Coming up, will new rules for the fast-growing drone industry dampen interest from both consumers and investors? Here's what to watch tomorrow. If you've been living in a cave, you probably didn't know that the Federal Reserve could announce its first rate hike since 2006. Big meeting tomorrow. On the data front, a read on real estate with the housing starts report, a measure of industrial production, and oh yeah, that Fed meeting. That's what to watch tomorrow. Well, new rules for the drone industry starting next week. Owners of consumer drones will have to begin registering them with the government. But as Josh Lipton reports, there's concern that all those new rules could dampen both consumer and investor enthusiasm.
2015 was touted as a defining year for drones, with the category positioned for steady growth. Unit sales were forecast to approach 700,000, a jump of more than 60%, according to the Consumer Technology Association. But now that growth is in question. The Federal Aviation Administration announced new rules this week that will require recreational drone users to register their flying machines in a national database. Those who purchase a drone before December 21st must register it by February 19th of next year. And drones bought after December 21st have to be registered before the first flight. Registration will be free for the first 30 days. After that, the fee is $5. Lawyers representing the drone industry aren't pleased with the fee, but don't expect these new regulations to impact growth.
I'm confident that the technology is just too innovative. It's too powerful to be held back, both on a commercial and recreational level. The United States has to catch up. And any effort to promote responsibility, any effort to demonstrate that the industry is going to take steps to be a partner in responsible use of the technology, that's a good thing.
Not everyone is confident. Some venture capitalists in Silicon Valley question whether the drone industry is a smart investment.
But I think you're going to see a regulatory framework that's going to be much tighter with drones than with other consumer electronics, and that is absolutely going to have an impact on venture capital financings in this area.
Investors have been fans of drones, committing nearly $430 million to drone startups since last year, according to CB Insights. Now the question is whether investors and consumers will be as enthusiastic about this technology given these new regulations. For Nightly Business Report, I'm Josh Lipton in San Francisco.
Hollywood showed up in force for the premiere of the new Star Wars film. Disney closed down 4 blocks on Hollywood Boulevard and screened the film in not 1, but 3 theaters last night. Our cameras caught up with Disney CEO Bob Iger, who said he never could have predicted the amount of interest in the film, not just in the U.S., but worldwide.
When we bought Lucasfilm, I knew that there was global interest in Star Wars movies. There hadn't been a film out in 10 years. It hadn't really even been released in certain parts of the world. So while we had strong instincts about level of interest and what it might do, we had no idea. And I will say to you, in all honesty, standing here tonight, interest in this film worldwide has exceeded those expectations by a lot.
4 more Star Wars-themed movies are due out by 2020.
That's called a franchise.
That's right.
And finally tonight, are you traveling this holiday season? You'll have lots of company. Holiday travelers will top 100 million for the first time ever. That's nearly 1/3 of the U.S. population who plan to travel at least 50 miles from home between December 23rd and January 3rd. And according to AAA, it's the 7th consecutive year of growth since the 2008 recession, and it triples the number who traveled during the Thanksgiving weekend. Mercifully, it'll be spread out over more days.
Yeah, I'm looking forward to staying put right here. But anyway, that's Nightly Business Report for tonight. I'm Sharon Epperson. Thanks so much for watching.
And thanks from me as well. I'm Tyler Mathisen. Have a great evening, everybody, and we'll see you back here on Fed Day tomorrow.
That's right.